Welcome back to The Explainer, everyone. Let's just jump right into it today, because we are unpacking a massive macroeconomic shift that's basically rewriting the entire playbook for 2026. Think of it like a giant rock being dropped right into the middle of the economic pond. We're tracking this massive chain reaction that starts at the Federal Reserve, ripples outward to violently split the stock market, and eventually crashes right into corporate boardrooms. Let's get right to the catalyst. 75 basis points. That is the number sending absolute shockwaves through the financial world right now. Look, for months, the market was just kind of assuming the Federal Reserve would keep cutting rates, right? Easy money. But a shocking new forecast from Bank of America has totally flipped the script. They're actually predicting 75 basis points of rate hikes in 2026. And you might be wondering, why? Well, it boils down to two huge reasons: unexpected resilience in the labor market and a brand new face at the helm of the Fed, Chair Warsh. We are officially entering a completely new era of policy. So that brings us to the billion-dollar question on literally every investor's mind right now. Will the Fed just sit on the sidelines and delay cuts, or are they going to actually pull the trigger on new hikes? To really grasp the panic driving this conversation, we need to look at the cold, hard data that new Fed Chair Warsh is staring at on his desk today. Because let me tell you, the numbers are telling a very clear and very stubborn story. Just look at the massive gap between economic reality and the Fed's ultimate goal. Headline personal consumption expenditures, or PCE, which you probably know is the Fed's absolute favorite inflation gauge, is sitting comfortably at 3.8% year over year. And Core PCE is right at 3.3%. Obviously, we are nowhere near the Fed's 2% target rate. Chair Warsh is walking into an environment that is actively hostile to rate cuts. It's being driven by sticky supply-side factors like tariffs and energy shocks. And the thing is, those simply cannot be fixed by printing easy money.
Okay, so what exactly would force them to actually hike rates? The answer is hiding right there in the labor market. Right now, unemployment is hovering in what we'd call a healthy 4.2% to 4.5% range. It's stable. Wage growth is relatively benign at around 3.5%, but here is the massive trigger warning. A sustained drop below that 4.2% threshold, that would give policymakers the undeniable proof they need that the labor market is overheating. And if that happens alongside the sticky inflation we just talked about, yeah, that's exactly when those 75 basis point hikes become a harsh reality. The hurdle for rate cuts right now is essentially a sheer cliff face. Based on the recent data and the Fed's whole reaction function, the economic reality strongly argues for just sitting on the sidelines. We are locked into a tight, restrictive monetary policy for the foreseeable future. And this macro earthquake, it is violently splitting the stock market right down the middle. Which brings us to the resulting tsunami in the financial markets. If you've glanced at your portfolio lately, you might be scratching your head. How can one part of the market be popping champagne while another part is bleeding out? As we move from the macro level of Fed policy down to the market reaction, we are seeing a totally fascinating divergence. This insane market tension is the direct result of those exact rate hike fears we just covered. We've got the Dow Jones hitting record closes, while the Nasdaq and the S&P 500 are slipping. So why the split? Well, high interest rates heavily punish growth-dependent tech stocks. Tech valuations rely on future earnings, and when interest rates go up, the present value of all those future earnings just drops. So what do investors do? They flee speculative tech and they park their money in the reliable, cash-generating fortresses over in the Dow. All right, so we know the Fed is squeezing the economy, and the stock market is fracturing in response. But what does this actually look like on the ground? Like, how are real businesses surviving this kind of pressure? To answer that, we're going to dive into a massive corporate shock story. We need to ask, what does a massive restructuring at a giant like FedEx signal for the broader economy? Because corporate giants aren't just sitting around waiting for the Fed to come save them. $2 billion. Now, this isn't some temporary revenue bump. This massive number represents the permanent structural cost savings that FedEx is aiming to achieve by 2029. Think about it. In a low-growth environment where you absolutely can't rely on cheap borrowing or infinite consumer spending to pad your margins, you have to look inward. You literally have to cut the fat. And FedEx is doing exactly that with a remarkably aggressive structural pivot. And the main engine driving that $2 billion savings, it's called Network 2.0. This is FedEx fundamentally changing its corporate DNA. Historically, FedEx Express and FedEx Ground operated as completely separate networks. We're talking separate trucks, separate facilities, separate management, the whole shebang.
Network 2.0 is their long-term transformation strategy to fully unify those networks into a single, highly efficient machine. And they're moving fast. By the end of Q3 fiscal 2026, they already had more than 35% of eligible volume being processed through 400 of these newly unified facilities. All of this builds into a brilliant three-step survival master plan. Step 1, simplify operations by spinning off FedEx Freight. Commercial freight has been dealing with really soft volumes lately, so by shedding it, FedEx instantly becomes a pure-play parcel delivery company. Step 2, aggressively execute that Network 2.0 unification we just discussed. And Step 3, capitalize on market gaps by expanding their Amazon partnership while their competitors retreat. This, my friends, is exactly how you play offense in a tough economy. Now, I want to nerd out for a second and zero in on the mechanics of that Freight spinoff, which they completed on June 1st, 2026, because it is an absolute masterclass in financial engineering. FedEx created a separate, publicly traded company with the ticker FDXF. For every 2 shares of FedEx stock you owned, you were handed 1 share of this new company. But here is the genius part. FedEx kept a 19.9% stake in the new freight business. That gives them a massive asset to monetize over the next 24 months. Plus, because FDXF was immediately added to the S&P 500 and the Dow Jones Transportation Average, passive index funds were literally forced to blindly buy an estimated $2 to $4 billion worth of the stock. It's an incredible capitalization roadmap. And you know what? The market has completely validated this strategy. Trading Key recently hit the nail on the head, noting that investors are enthusiastically rewarding this proactive transformation. They pointed out that the stock's surge is driven by structural cost savings, broadening margins, and a growing level of confidence. By mid-June 2026, FedEx shares were trading near their 52-week high. That is a recovery of roughly 90% from their previous lows, backed by 4 straight quarters of earnings beats. It just proves that in a world where the Fed is putting a lid on the economy, proactive corporate structuring is the most direct path to recovery. You can't control inflation, but you sure can control your operating margins. So, let's pull all of these threads together for our 2026 reality check. The days of easy money, they are officially in the rearview mirror. With sticky 3.8% PCE inflation and a really resilient labor market, the Fed is essentially blocked from cutting rates, meaning up to 75 basis points in hikes are still on the table. This macro pressure is causing violent splits in the market, punishing speculative tech while rewarding established value players like the Dow. And down at the ground level, survival demands huge corporate pivots. Companies that ruthlessly restructure and cut costs, just like FedEx did with Network 2.0, are the ones who are going to actually thrive in this new era. Which leaves us with one final, absolutely vital question for you. Knowing that the Fed is holding the line, knowing the market is heavily divided right now, and seeing exactly how major corporations are having to restructure just to survive, how are you adapting? Are you still holding on to yesterday's growth strategies, or are you proactively positioning your portfolio for a high-rate, fundamentally restructured 2026? Think about that for a bit. Thanks so much for joining me on this explainer, and I will catch you in the next one.